All right, in this lecture, we're going to talk about bond conversions. So companies can choose whether to finance their operations through debt or through equity. Debt does introduce more financial risk because there's the obligation to pay interest and also the obligation to repay any principal that's been borrowed. But at the same time, that debt can increase returns to equity investors. Of course, if times are good, that's going to be a positive return. If times are bad, though, on the downside, it's going to increase losses that equity investors experience as well. Convertible debt is an opportunity where a debt holder has an option to convert their debt to equity at a future date. There's really no direct impact on income that's attributable to the conversion. You simply take the debt off the books and you bring the equity onto the books. However, there is an indirect effect, and that indirect effect usually is lower interest expense because the conversion option is valuable to the debt holder, and therefore usually the yield on the debt is going to be lower than if there was no conversion option. All right, let's walk through an example. A firm issues $300,000 of 5% 10-year annual bonds for 102. The bond includes a conversion option where each $1,000 bond can be converted to 20 shares of common stock. The bond is issued on January 1st, 2018, and 250 bonds are converted on December 31st, 2020. We're going to assume the firm uses straight line to amortize the bond premium just to kind of keep it simple. All right, so the initial issuance hopefully is fairly straightforward. It's issued at 102, so the firm's going to receive $306,000. The bond payable is $300,000. Of course, the difference goes into a premium on bond payable. For the purpose of this example, we're not going to walk through the interest calculations. Of course, there would be interest payable and interest expense and all those types of things that would need to be recorded until the bonds are converted. But for this example, we really want to focus on the conversion itself. And so, first of all, we have to determine, okay, what is the par value of the bonds that are being converted? Of course, there are 250 bonds, and each bond has a par value of $1,000 for a total of $250,000. We also have to determine if there is any remaining premium balance. And in this case, the premium balance in total was $6,000, and if you kind of divide that out by the number of bonds, or that 2% premium is about $20, is exactly $20 per bond. There would have been 2018, 2019, and 2020 amortization, which of course is straight line, meaning that there are 7 years of amortization remaining on that premium, and so 7/10 of the balance remains on each bond. And so we take that 7/10, multiply it by the premium on each bond, which is $20, and we multiply it by the number of bonds that are being converted, and therefore we get the balance of the premium that needs to come off of our books as $3,500. We also have to determine the number of common shares that are going to be issued. In this case, each bond is convertible to 20 shares, and so there'll be 5,000 shares issued at the bond conversion. And so the journal entry, hopefully we see there, the bonds payable is debited for $250,000. The premium is debited for $3,500, and of course the par value of the common stock is $1 per share. Therefore, we have a credit to $5,000. Ultimately, at the end of the day, when the bonds were initially issued, of course they were issued for debt, but eventually they did turn into contributed capital. And therefore any amount above par goes into our additional paid-in capital - common stock account.